Hello students. Today we are going to learn chapter 3 of macroeconomics, and that is money and banking. Now money, we know that it is commonly accepted medium of exchange, and in any economy which exists of only one individual, then there cannot be any exchange of commodities, and then there would be no more role for the money. So first let's understand what is money. Money is any good that is widely used and accepted in transaction involving the transfer of goods and services from one person to another. So in short, we can say that anything which is acceptable in exchange of goods and services is called money. So let's say, for example, that when we talk about earlier times, there used to be barter system, because economic exchanges without the mediation of money is known as barter system. But during barter system, there were certain problems of monetary value. Now, when we talk about evolution of money, it started with barter economy, that is, commodity itself was considered as money. Then we had metallic money, wherein we were using silver coins, gold coins. Then we had paper money, and then plastic money or e-money. So, as I said, that exchange of goods for good is called barter system. But barter system had suffered from many of the drawbacks, like lack of double coincidence of want. Now, let's consider an individual who has surplus of rice, which he or she wishes to exchange for clothing. Now, she has to find a person who is ready to exchange rice in exchange of cloth or anything which he or she is desiring. And if the opposite person is not ready to accept the rice in exchange of clothes or anything with the other person is desiring, then she or he will have to find out a person who's ready to exchange the commodity or accept the rice. So during barter system, there was lack of double coincidence of want. There was also lack of common measure of value, which means that it was difficult to measure goods in terms of money. Like, let's say, for example, that when we say that a watch is costing 500 rupees, it means that a wristwatch can be exchanged for 500 units of money. Like, let's say, for example, if the price of pencil is rupees 2 and price of pen is 10, then it's easy for us to calculate that the price of pen with respect to pencil is that pen is worth 5 pencils. But in case of barter system, it was very difficult to measure the value of the two commodities. There was also lack of divisibility, that there were certain goods which were not possible to be divided. Like in the earlier times, let's say, for example, the farmer who's manufacturing rice, wheat, or any of the pulses or grains, it was easy for him to exchange. But what about the people who in earlier times were engaged into dairy? So such products were not divisible. And it is also difficulty in storing wealth. Now, it is again difficult in storing wealth because there are certain goods which you cannot store. Like, let's say, for example, rice or wheat or any commodities which are perishable. So, those commodities cannot be stored for a longer period of time. And there was also difficulty in borrowing and lending. And because of the evolution of money, all these problems were eradicated, because it is the money wherein there was no problem of double coincidence of want, because it could be exchanged. It had a money value or a face value. And it was easy to measure the value of the goods. And money, it's easy to store for a longer period because it is not perishable. So now let's understand what are the functions of money. When we talk about functions of money, there are three functions: primary function, secondary function, and contingent function. Now, one by one, let's understand. When we talk about primary function, it has two functions, medium of exchange and measurement of value. So as a medium of exchange, it facilitates trade, that buying and selling becomes easy to do or to deal into any kind of trading. It also removes the problem of double coincidence of bond, because here it is the money which is used to buy or sell the commodity, and it facilitates modern production aspect like division of labor or specialization. Now, when we talk about the primary function of money as a unit of account or as a measure of value, money acts as a measure of value and it can be used to compare the value of goods and services. Like just now, I gave you an example of a pen and a pencil, wherein the cost of pen is 10 and the cost of one pencil is 2 rupees, which means that one pen is worth 5 pencils. So it is easy to measure the value, and it also facilitates efficient allocation of limited resources. Calculation becomes easy, and it also helps to set the prices of the product. Now, when we talk about the secondary functions of money, it acts as a store of value. It is very easy to store money because it is not perishable. Like the problems which were existing during the barter system, where one could not store the commodity for a longer period of time, whereas in case of money, it is very easy. So this means that holding wealth in form of money for future transaction and investment purpose can be done. It also promotes saving because with the help of money, you can make more savings and more investments, unlike which was lacking during barter system. Production gets expanded due to increase in investment and economic growth due to increase in production. So you can say that an opportunity cost is involved here in case of money. When we talk about secondary function as a standard of deferred payment, money enables the people to borrow and lend agreed amount. So it is very easier and convenient way of measuring debt and repaying back the debt. So this function links both present and the future. Now, when we talk about deferred payment, it means the future payment. So it becomes easy when you have money. When we talk about contingent functions, we can say that distribution of national income is done in terms of money. When we say distribution of national income, we have various resources, that is land, labor, capital, entrepreneur. All these are paid in terms of money. So we can say that for land, we are paying rent. For labor, we are paying salaries and wages. For capital, we are paying interest, and entrepreneur earns profit. So if you observe, the distribution of national income is also done in terms of money. And it is also the basis of credit and credit creation. So when somebody wants credit, or if credit creation has to be taken place, again, it takes place in the form of money. There is also guarantee of solvency and maximization of satisfaction and bearer of option. Now, when we talk about value of money, it has official value and real value. And further, real value can be subdivided into internal and external value. So first, let's understand what is official or face value of money. This is the value which is indicated on the face of notes and coins. Like let's say, for example, you have 10 rupee note, and on that 10 rupee note, we can see the number 10 written, or on a 500 rupees note, we can see returned as 500. So that is the face value of note or any coin which is imputed by the government. Now, when we talk about the real value or the purchasing power, this is the amount of goods and services that can be brought with the given amount of money or per unit of money. So the real value highly depends on the general price level of the goods and services. So if the general price level of the commodity increases, then the real value also increases. Now, when we talk about internal or domestic value, this is the quantity of goods and services that can be brought with the particular unit of currency within country. Like in India, the currency we follow is rupee. So this depends on the general price level in the country again. So when the domestic price level falls, the internal value of money increases or rises. And when we talk about the foreign value of money, this is the rate at which one currency is exchanged to another. So in other words, it is the exchange rate between the country. Now let's say, for example, when we say $1, for example, we take it approximately to be 70 rupees. So for $1, our rupee value is 70 rupees. That is the foreign value or external value. Now, first let's understand all these basic terms like liquidity. Liquidity refers to the ease in which an asset can be converted into cash. Anything which can be converted into cash or any asset which can be converted into cash is known as liquidity. So liquidity describes the degree to which an asset or security can be quickly brought or sold into the market without affecting the asset price. Like let's say, for example, if I have gold, gold is a liquid asset. Why? Because I can sell that gold or buy that gold into the market and get it converted into money. Now, assets according to the range of liquidity, the most liquid asset, of course, is cash. Then we have demand deposit, we have time and saving deposits, money substitutes, financial and physical assets. So financial and physical assets, we can take an example of shares, debentures, bonds, or physical assets like land, property, buildings, house. All these are physical assets, which are liquid. So we have arranged it according to the liquidity. So from most liquid asset, that is cash, to physical asset. Now, there are certain reasons as to why people keep wealth in the form of money rather than the other form. Because money is the perfect liquid. It is easy to store and it is easy to carry. Like in barter system, it was very difficult to carry on for trading purpose. Why? Because in earlier times during barter system, the mode of exchange was goods or the commodity. So it was very difficult to carry it every time for a trade. Whereas in case of money, it is very easy to store and it is portable and easy to carry. And uncertainty in the market value of no monetary assets. Thank you.